Hey, so I want to show you an example of a debt consolidation refinance. A lot of people are carrying debt, not just the mortgage, but maybe high balance credit cards, even student loans, expensive cars, things like that. And the payments are high. Credit cards usually only have minimum payments, which barely attacks the balance. And many people pay years on big balances. And, it takes a lot to really pay them off sometimes. And, it's easy to get behind. I have a client now. He had and a lot of times the interest rate on the new mortgage doesn't even matter. A lot of because what you're doing, the result, what you're gaining, usually is way better than what the number is on the rate. So your benefit is what you're getting, not what the rate's called. Um, so this guy had a 20-year loan like 2 years ago. Okay, credit, good income, but he's holding out on like $36,000 of credit cards that he's had for a while with pretty high payments. And he was looking to get some cash out to fix up his property. Actually, no, to finish fixing it up, but also to replenish some of his savings that he used to do a lot of the upgrades that he already finished. So his current mortgage was okay. It was a 20-year loan, paying $1145 a month, right? But he was paying $1,200 plus on his credit cards, and that's just the minimum payment. So in order to really make a dent, you'd be paying almost double that right now. So right now, his total outflow was about $2,400 a month. So what we did was we looked at consolidating it into a new 30-year loan at a lower rate. And what that did is that dropped his payment from $2,400 down to $1,500. And not only that, but not just paying off his debt, but he also got $175,000 cash in hand at closing. So his total actual monthly savings is like $850. That's from what he was currently paying, of course, minimum payments. But when you factor all this stuff in, what am I doing here? When you factor in the savings that he saw, what he wanted to do was kind of stay on the same track. So what he decided to do is, hey, I'm going to take what I was already paying and I was comfortable making those higher payments, and I'm going to make the exact same payment towards my new mortgage. So what he ends up doing effectively is paying off his loan in a year, like almost 2 years less time from what he was doing. So if he didn't do anything at all, he would have 17, almost 18 years left on his mortgage. By consolidating everything into one loan and paying the same amount each month, um, he was getting a whole bunch of money up front and knocking off almost 2 years off his term. So that's just one benefit. I'm going to do a video in a few minutes on another client who had a lot more debt, including $1,000 a month car payment. And what they're doing is they're getting into they were in a 30-year loan for a while, and we're going to get them down to 15, and they're actually going to pay their house off in 6. So stay tuned.